Hi, this is Andrew Faldy with SMB, and today I'm going to tell you about THETA, the time decay edge. I'll tell you 5 things today. First will be time decay math, how we actually calculate theta. We're going to talk about the fact that theta is a theoretical decline in value. There are other variables that matter, and it is something that is not going to happen the same way every day, but it is a forecast for us to use. I'll show you how you can see it visibly in just about any brokerage platform where you can see option prices. You can see it in the options chain, you can see it in the options chart, how option prices have changed over time historically. I'm going to talk about those other very important variables that theta assumes do not exist in order to give you a value of rate of change of the option prices. But there are other very important variables that leave risk involved in options that we need to consider in order to mitigate them and allow that time decay edge to work for you. And I'm going to give you some optional homework for you to go see for yourself over the next several days. 2 things. Go look at the historic pricing in the option chains and the option charts, and then observe for yourself over time how some of these options move compared to the underlying market. And through this observation, you can determine if possibly positive theta trading may be an advantage for you. Or at minimum, you may start to understand better why some of these options don't work out even if your underlying trade thesis was correct. So here is the time decay math put very simply. 1 day rate of decline of the option price. Technically it would be called the 1 day rate of change in option price, but I wrote decline because the expectation is for a decline because time always moves forward toward the expiration date. So is the expected decline rate of options. And that is today's value minus tomorrow's value. So the rate of change for 1 single day. So we express that using T value. So T is the day of observation. In the real world, that is just the ever-present now. In backtesting or historic analysis, it's at the moment of observation. So that's T. And plus or minus is the number of days from then. So theta is just giving you a single day value. In some more advanced strategies that we discuss, we'll use things like T plus 10, T plus 14, T plus 21. And those are giving you the exponential look at how theta changes over time. But for now, we just look at the fact that theta is a 1 day value. Secondly, theta is a theoretical decline. It's not a guarantee, it's not a contract for what the price will be the next day. It's a forecasted rate of decay. If all other variables are removed, this is what's expected to be the change in rate or the change of the price of the option. It's not a guarantee, and it's not something you should actually even expect to see happen because of all those other variables. Actual theta ebbs and flows is how we like to describe it. So sometimes it will not appear to have a lot of theta decline or decline of the price of the options, and then it will come in later. It'll come in faster than you expected. And there's also a couple other types of theta as far as the rate of decline and how it's different. But in general, just know it's not a forecasted or guaranteed rate of decay, and that actual decay will happen little by little over different periods of time and volatility. Number 3, this decline in option pricing is visible. You can go see this for yourself. You can see this through pricing in different expirations, and you can see it through charting of options and underlyings. I'm going to do this for you right now and show you this. So first we'll look at the different expirations. All right, so this is options chain here. Make it a little smaller, just kind of condense it a little. So we're going to look at we'll start with 63 days. 63 days out, we'll look at one option. Here we look at the 2850. Now remember, the market's open live, so things will be a little varying, but you're going to see it's right around 44 to 44 and a half. That's 63 days to expiration. At 35 days to expiration, the option for the same price is 27 3/4 to 28 1/4. So you can see that options with less time to expiration are cheaper. We can observe this on a stock as well. we'll look out at 90 days. And we'll switch to the other side. So the 225 option on the calls, 605 to 615. Then we'll go to the 225 option with 60 days to expiration, 63. Those are 355 to 365. Then we can come in with 35 days. It's $1.80 to $1.81. So you can see that the options with less time to expiration are cheaper. That's one very simple way of observing that options with less time to expiration are cheaper. And what will happen is this November options, which are 91 days now, in 30 something days, around 30 days, they're going to be at 60 something days to expiration. And with, again, with all other variables unchanged, the expected value would be the same as what you see at 63 days now. The other variables that will change though are the price change of the underlying, so changing how close the option is to the market, and then also volatility. If the underlying market, Apple here, is going to be a lot more volatile in the future, then pricing will maybe go up a little bit, at least relatively. So even if the relative value goes up, you can still have a decline in value because of options. If the market goes up in price, those calls may become more expensive, but time decay will also still kick in a little and will erode some of that increase in value. So these are observations from the options chain. Let's look at the this market here. So this is going to be a chart of Apple. There's a way to actually look at a chart of the options. So if you click this little down arrow, or you can find this in other platforms, but you have to find the exact way of quoting the option. It's a little different in different platforms. Here we can see it. So I'm in the, now in the, excuse me, in the options tab. So I click on Apple in the options tab, and all the options come up. So what I'm going to do now is I'm going to go look at about 35 days out, and I'm going to see what the puts look like that are near the mark. Actually, I'm going to go a little out of the money. I can just click on one and change one of these here. So I'm going to look at the 205 puts. So right up here now is that it's a little bit cut off. Here you can see it is the symbol for it, dot Apple 180921 P205. So it's a long symbol for the put in there. What we're going to do is zoom in just a little. I actually chose this by random, if you want to believe me or not, but I chose this by random because I want to show the characteristic and how these options change. So here's the put option. Now we know the market has risen, so the puts should decline regardless. But what I look at is this specific period here, from August 3rd through August 13th, maybe even through the 16th. So we'll kind of look at that 3rd through the 13th and the 16th. So what I'm going to do is I'm going to copy that option code so I can easily put that back in and go back here, zoom in on this, and go back and find those dates. So here's the 3rd through the 13th. So if you see, the actual movement in the market is almost imperceivable. There's not a lot going on there. Very, very flat market. Here, if we look at the option though, we can see that the decline in the option was a little bit more persistent in there. Now this was a quick random example. I could probably go find one where you'd see a huge change in there, but this one was just a slight acceleration of the time, and that was a very, very short period of time, just a few days, so you wouldn't really expect that to change a lot in value. So this is though how you see the option pricing. You go and you find the actual symbol for the individual option. You can observe the price decline over time. And you can use that in your observations of comparing how do the options change in value compared to the underlying. And you can start to see, what if I were to trade that option instead of trading the underlying, the futures or the stock or the ETF? If I traded that option instead, can I get in and out of that and follow something that has a more persistent movement to it because of premium decay or not? And that's how you can look at that, is looking at that option. I found that using those options adds a lot of, or the charting of options helps a lot in that visualization. So the other variables that matter a lot. News. News can change option pricing from being something that's persistently declining to something that holds its value or even increases in value regardless of time. And news can come in a couple forms. One is pending news, so that's known new information. You don't know what the information will be exactly, but you do know there is new information expected. And when you have an unknown that is known, does that make sense? That means you know there's something. Everybody knows there's something that's unknown, and it will become known in the near future. That greatly impacts option pricing and can sometimes reverse the clock on the decay and actually make the options hold their value or even rise in value because of news. That's something very important to note. Secondly is volatility, and this is actual volatility, not the implied volatility, complex math. This is talking about actual volatility. So if buyers and sellers start pushing the price into bigger ranges and bigger daily moves, higher ranges as far as how high each day and how low each day and what that total range of each day is and the total movement from day to day. If that amount starts to increase, options can also increase with that. There's that expectation of movement will spill over into the options market as the actual market begins, the underlying market actually begins to move more. And that happens in the opposite way. If volatility starts to contract, daily ranges get smaller, day-to-day movement gets a little tighter, then that volatility can also spill over into the options market, and the options can actually become cheaper faster than even just the rate of change of time. Thirdly is tail risk. So this is a variable not just about option pricing, but this is about the other side of the coin of this great edge of time decay. And time decay is great. It is something that's persistent and available. We can filter out times where it's less persistent. We can find options that are more efficient to trade. We can use spreads to define some of our risk. But oftentimes in many strategies, you are going to take an outsized risk, tail risk, compared to that individual return for each trade. There are ways to control this. There are spreads that help you define that risk. But nonetheless, as a just outright simple thing, if I pull this chart back over, if you want to ride something that has a nice persistent decline to it, something that's a little stronger than even the underlying market is going on the upside, you have to recognize that this can be an exponential increase against you if you want to be on the selling side of this. So here's the homework for you. Observe this for yourself. So don't just take my word for it, but go and be a student of the market, be an observer of the market, and look at an options chain. Check out how those options prices are different based on the amount of timed expiration. That'll just tell you a very simple look at, because of nothing else, it's just the same point in time with all the same information available because it's just all known right now, what those different prices are. And then look at an options chart and go a step further than that. We did a very quick one because I just wanted to show you how to pull it up. But what you can do is really observe carefully. How does the option change over the next, or over a 2-week period of time or a 3-week period of time compared to what the stock did over a 3-week period of time? And do you see more opportunity there? Journal ideas that you have. Journal your ideas, or your trading ideas, and the related options price change. So this is now, you're moving into the forward real world and documenting this and observing this. So as you come across trade ideas, go look at the option prices and write them down. Keep track of them. Put them in a spreadsheet journal, a written journal, and start to keep track. How did the options change in price compared to the underlying? How did the options change in price compared to what would have worked out or what did actually work out for you in a trade? And you'll begin to see how those options behave and how you may begin to take advantage of them. So I want to invite you, there is a workshop where we're going to talk about theta. It's this coming Thursday at 1 o'clock in the afternoon Eastern time. That's New York time. Now, if you're watching this video later, that's fine. We are going to record it so you can come in anytime in the future and check out the recording. If you're watching this like most people do when it first comes out, then that's coming up this coming Thursday, 1 p.m. Eastern. We're going to have a live, detailed look at theta. I'm going to take questions. Anything you want to see specifically, any questions you have about how theta works and types of trades that take advantage of theta, we're going to be looking at that in great detail. And we're going to talk about different types of theta. There are so many types of options available on both sides of the market, in different types of markets, different circumstances, different types of spreads. And a big one is the different amount of timed expiration and different distances from the underlying price of the market. And all of those changes in which options you're looking at affect the typical pattern of theta. And we're going to look at how to take advantage of that, at least how to put yourself in a place where you can make theta work the best for you, control your tail risk, spread off and define risk, etc. We're going to learn when theta slows down and speeds up and strategies to profit from this, and especially on a portfolio basis. We talked about some of that pending news, things like that. So we're going to look for opportunities where theta may be accelerated or decelerate or possibly even not really exist because of other factors. And you can set up a portfolio that whatever the market does, you can take advantage of theta, and you can also mitigate theta as a risk if you're long options. And we're going to talk about how to control the tail risk of positive options trades compared to what is most common and popular in positive theta options trades. So you can get that. There's a tiny little link down there at the bottom, but we'll put it in the description too. It's smbu.com/workshop. Hope you want to check that out. I'll be there live, and I'll be looking forward to seeing you there and taking your questions.